In this video, we shall learn what is meant by a lease. How to account for lease transactions is pronounced by the accounting literature. In India, it is the Accounting Standard 19 issued by the Institute of Chartered Accountants of India. We will learn the relevant portions from the standard at the appropriate places. Lease is an arrangement for using an asset for a period of time without buying it by making a payment or a series of rental payments. This is an alternative available to someone wanting to use an asset without having to lock huge sums of money in purchasing it. Let us understand lease with the help of an illustration. Imagine there are two persons, Ramesh and Rakesh. Ramesh owns a backhoe, an earth mover, and Rakesh has got a granite mine. Rakesh is in need of a backhoe for use in his mine but doesn't have the money up front to buy it. Therefore, he approaches Ramesh, strikes a deal whereby Ramesh is to provide the backhoe to Rakesh for using for an agreed period, say 3 years. Accordingly, Ramesh gives away his earth mover to Rakesh for using. An agreement is struck between Ramesh and Rakesh called lease agreement, and Ramesh and Rakesh become the lessor and lessee respectively. During the period, Rakesh, the lessee, uses the backhoe as if it is his own and in return keeps making periodic lease payments to Ramesh. Now, you must have seen for yourself, lease is an arrangement in which the owner of the asset lends the asset to another person for using for a specific period in return for a payment of lease rentals. Here is the definition of lease provided by the accounting standard. Lease is an agreement by which the lessor conveys to the lessee the right to use an asset for an agreed period of time in return for a payment or a series of payments. The owner of the asset is then called the lessor, and the person who gets to use the asset is the lessee. The agreed period of 3 years is the lease term. Periodic payments are called lease rentals. Now, let's get back to our illustration. At the end of the lease term, at the end of the agreed period, the lessee may return the asset back to the lessor and be done with it. This form of lease arrangement is called an operating lease. Alternatively, at the end of the lease term, the lessee may retain the asset himself and the lessor transfers the legal ownership in the asset to the lessee, and the lessee becomes the owner of the asset himself. Then the lessor and lessee become the seller and buyer respectively. This form of lease arrangement is called a finance lease. In a finance lease, at the end of the lease term, usually the legal ownership in the leased asset gets transferred to the lessee. In such an arrangement, right from the inception of the lease, it is evident to the parties that the lessee will acquire ownership in the asset by the time the lease ends. Therefore, the risks and rewards incidental to ownership of the leased asset remain with the lessee right from the start of the lease. For example, during the lease term, if there is an idle capacity or if the asset could not be used as the lessee had anticipated, the resulting loss is on the lessee. If the asset suffers any damage or needs some repairs or overhaul, it is the lessee who will have to take care of them. He will spend in carrying out such repairs or maintenance as if it is his own asset. Similarly, the lessee can use the leased asset as if it is his own. This is what it means to say the risks and rewards incidental to ownership remain with the lessee all through the lease term. Please note, it's not the actual ownership, rather the risks and rewards connected to ownership remain with the lessee. In an operating lease, at the end of the lease term, the leased asset reverts to the lessor. It is the converse of the finance lease. It means the risks and rewards of ownership always remain with the lessor. Now, let us see what the accounting standard says on these two types of leases. The standard defines a finance lease as one in which substantially the risks and rewards incidental to ownership of the asset are transferred to the lessee. The operating lease is defined by the standard as one which is not the finance lease. From this, you will understand, in the words of the accounting standard, the risks and rewards of ownership of the leased asset, if held by the lessee, then it is to be classified as a finance lease, else it is to be called an operating lease. It also says, the classification of a lease into a finance lease or an operating lease depends on the substance of the arrangement rather than the form. This means that every lease arrangement has to be analyzed to understand the substance of the contract and to see where the risks and rewards incidental to ownership of the asset remain, if it is with the lessor or the lessee. Having said all of this, the process of analyzing a lease arrangement to understand the substance is often challenging. In order to help with the analysis and classification, the accounting standard also provides certain conditions called qualifying conditions. There are 5 such conditions. If a lease arrangement meets even with one of the conditions, then it is to be classified as a finance lease. On the other hand, if a lease does not meet even one of the 5 conditions, then it is to be called an operating lease. Now, we shall look into these conditions one by one. Condition 1. If a lease arrangement explicitly says that the legal ownership in the leased asset will get transferred to the lessee at the end of the lease term, then it's a finance lease. Condition 2. Imagine a 3-year lease. At the end of the lease term, at the end of the 3rd year, if the lessee wants, he can buy the asset for himself from the lessor by paying a special price called bargain purchase price. The bargain purchase price is significantly lower than the fair value of the asset as on the date. Let's say it's only 50% of fair value. Will the lessee go for the option? Most likely he will. Therefore, at the start of the lease itself, it is certain that the lessee will buy the asset at the end of the lease term by paying the special price. Let's recap. If you look into this arrangement, this also is a sale type arrangement. The lessee wants to have the asset, doesn't have the money. Lessor allows the lessee to take possession of the asset, keep using it for a consideration of just lease rentals, and at the end of the lease term, the lessee can buy it and keep it for himself by paying a nominal price. Thus, the lessor provides financial assistance to the lessee for him to have the asset. Therefore, this is also called a finance lease. Condition 3. Let's imagine the economic useful life of the leased asset is, say, 3 years. And the lease period is also 3 years. That is, the lessee is going to use the leased asset for the whole of its economic useful life. By the time the lease ends, the asset is not going to have much value because the lessee has already utilized all the benefits from the asset. The lessor gives the asset to the lessee and allows him to enjoy all the benefits of ownership, collects the consideration in installments over the lease term. Whether the actual transfer of ownership in the leased asset to the lessee happens or not is immaterial, because even without having the ownership, the lessee enjoys the asset for the whole of its economic life. In real, the lessor provides financial help to the lessee to enjoy the asset like an owner would do. Therefore, this is also called a finance lease. What if the lease period is slightly lower than the economic useful life of asset? Would it still make it a finance lease? Yes, if the lease period covers the major part of economic useful life of asset, then also it's a finance lease. Now the question is, what is a major part? In general, 75% or more of the useful life of asset is considered the major part of economic useful life of asset. Condition 4. We know about the payments that happen in a lease arrangement known as minimum lease payments, MLPs. As the MLPs happen throughout the lease term, they are compounded in value, that is, includes interest component. When they are discounted to the date the lease starts, we get the present value of MLPs as at the commencement of lease. We keep this on one hand. On the other hand, we pick up the fair value of the leased asset as at the commencement of lease. Imagine in a lease arrangement where the present value of MLPs as at the commencement of lease equals the fair value of leased asset as at the commencement of lease. It means the lessee pays the fair value of the leased asset, that is purchase price, by way of lease payments throughout the lease term. If he makes lease payments that equal the price of the asset, it means he is the one fully using the asset as an owner would do. Whether the lessee gets the ownership of the asset or not is immaterial. The lease is just a financing arrangement whereby the lessee pays the price of the asset by way of lease payments in installments and keeps enjoying all the economic benefits from the asset right from the start of the lease. Therefore, this is also a finance lease. Now, a question. What if the present value of MLPs is slightly lower than fair value of the asset? Would it still make it a finance lease? Yes. Even if the present value of MLPs is substantially equal to the fair value of leased asset, then it's a finance lease. Now, we mentioned about discounting the minimum lease payments to the inception of lease. What discounting rate is to be applied for discounting the MLPs to the date of commencement of lease? This is a separate discussion. We will pick it up later. Condition 5. Let's imagine a company that is into manufacturing operations. It wants to have a huge manufacturing facility constructed for it. It doesn't have sufficient funds to invest towards that. It approaches a construction company and asks to provide a factory building under lease constructed according to its specifications. Accordingly, a lease agreement is struck between the parties and the lessor constructs the factory building and provides it to the lessee for using. As we see here, the asset is constructed specially for the lessee according to the specifications provided by the lessee. If at all it is to be used by someone other than the lessee, it has to be significantly modified. This simply means that it can't be used by anyone other than the lessee. From this, it is evident it is a sale type arrangement. The lessor constructs a factory building to the lessee and for the lessee and agrees to collect the consideration by way of lease payments. The lessee may not receive the legal ownership of the leased asset. Still, he is the one who is going to enjoy the whole of economic benefits of the leased asset. Therefore, this is to be classified as a finance lease. Now, let us bring up all the 5 conditions together. The first 2 conditions cover the situations where the lessee gets the ownership in the asset at the end of the lease term. The last 3 conditions cover the situations where the lessee does not get the ownership but still gets to use the leased asset almost to the whole of its economic usable value or life as a legal owner would do. The essence of all these conditions is that a lease is to be classified as a finance lease if either the lessee eventually gets the ownership in the leased asset or the lessee gets to use the leased asset substantially. In all these cases, please notice the risks and rewards remain with the lessee. These 5 conditions also mean that a lease which does not meet with any of these conditions is to be called an operating lease. In other words, if the risks and rewards do not lie with the lessee, then it is an operating lease. Why does a lease need to be classified into one or the other type of lease? If you wonder so, the answer is as follows. Depending on the type of lease, different methods of accounting need to be applied.